Finance strategies and navigating investment lending. Lending is the number one piece of the puzzle you need to get right, and it can really determine whether you can or you cannot invest in a property, but also it can help predetermine which types of properties and price points you can move forward with. Today, we're going to have a deep dive into this topic. We've got a very special guest, Lewis Johns, who's going to be walking us through this. Lewis is an investment lending specialist, but Lewis, I might give you, the time to introduce yourself, if you don't mind.
Yeah, lovely. Thanks, Julian. Thanks for having me on. I'm an investment lending manager at ALIC, the Australian Lending and Investment Centre. So we're finance brokers who predominantly look after property investors. So a lot more in-depth and strategic than the normal mortgage broking, just looking at products and rates. We spend a lot of time with our investor clients going through structures, strategies, what they're looking to achieve from their property investments, and just showing them different ways and different strategies that they can achieve their financial goals through investment lending.
Fantastic. And I guess just for the people who maybe haven't heard of ALIC before, I guess a lot of investors, you've got a very big reputation, but maybe just in terms of the size and scale of ALIC, would you mind just giving a bit of an overview on it?
Yeah, absolutely. So we've been operating as a company now for about 14 years. Predominantly out of the head office in Melbourne, and now we're also running a team in Brisbane as well. So we're actually going through a big expansion at the moment. We've got about $3.5 billion of loans under management, predominantly for property investors, and something like 14,000 clients as well. So we've got a good bit of scale, really experienced team, a lot of time spent talking to property investors. It's what we do all day, every day.
Wow. So you say 3.5 billion, you say billion there?
Yeah, about 3.5 billion of loans under management across the all of the brokers in the group.
Wow. Okay, so there's a fair bit of experience on the team at ALIC to say the least. I guess what we want to walk through first step for people listening is maybe if you could give us a bit of an overview in terms of what kind of lending strategies that clients can work their way through.
Yeah, absolutely. So the most important thing for us, and probably the very first thing that we actually talk to our clients about, is their strategy and what they're looking to achieve. So even in our first meetings, we might not even discuss products and rates and banks with customers. We want to find out what is it you're actually looking to achieve? Why are we buying properties? We don't want people just borrowing money and gearing themselves up massively without having a plan in place as to what they're trying to achieve and how they want to pay down that debt. So there's a really broad range of property investors out there, ranging from, it could be a young first home buyer who's just living at home with their family and they want to go out and get their first investment property just to get a foot into the property market and then use that as a bit of a springboard for growing their wealth in future. We might have people right at the other end of the scale who are coming up towards retirement and they want to start using their self-managed super fund to buy properties to help supplement their income as they move into retirement. So there's a real range of different scenarios out there and different strategies we use with our clients. The majority of investors in Australia are probably actually your sort of middle income Australians. So customers who they have the borrowing capacity to invest. They're not necessarily high net worth customers. They might be in a position where they've still got a mortgage on their own property, but now they're actually looking to use the equity and use their surplus income to actually go and get some more investment properties in addition to that. So there's a lot of different strategies we use. It could be that they are looking at a debt reduction strategy where they're trying to buy investment properties with a view to holding those for the next, say, 3 to 5 years, focusing massively on capital growth to get as much growth out of those properties as possible, and then selling those assets using the proceeds after paying a real estate agent and paying capital gains tax, and using the funds that are left over to actually clear their debt and pay off their own home loan a lot quicker. So there's a lot of work we do in terms of structure and strategy, and what are you trying to achieve now in the short term? What are we looking at for over a sort of 5-year plan, and where do you want to be in the next 10 years? And what do we actually put in place now to help you get there quicker? Because if we don't get the right structure in place now, it can be really hard to change that later on down the track.
Absolutely. Would you say that's fair to assume that that's what's probably the biggest difference from, working with, walk into CommBank, you just give you 2 pay slips, as opposed to working with a strategist and building out a strategy for yourself in terms of what's helped, build up this $3.5 billion worth of property for you guys?
Yeah, absolutely. So most bankers, most brokers, they're really focused on just products and interest rates. Okay, so a customer comes in, they want to buy a house, and then they'll say, well, we'll find you the best interest rate. Okay, so I think there's about 15,000 mortgage brokers in Australia, and we can all do that. we all email the same department of the bank to get the lowest interest rate. So there's not really any sort of point of difference there in terms of walking into a bank and asking for a rate, talking to a mortgage broker and asking for a rate. Where we differentiate ourselves is on the strategy side of things, and having that really deep knowledge and understanding of investment lending, and also taking a really deep interest in our customers' specific financial position, where they're currently sitting now, what are their assets and liabilities, what's their net worth, what's their borrowing capacity, where do they actually want to get to, whether that's getting into a position where they've paid off their house so they're really comfortable in terms of their cash flows, getting them into a position where they've got sufficient assets and deposit to be able to go and buy the dream house without taking on a huge crippling mortgage debt that they've got to pay off for the next 30 years, or getting into a position where they've got sufficient assets that they can actually choose to retire early because they've made some really smart property investment decisions earlier on in their life cycle. So we're really keen and really interested to find out all of those other details about the customer's financial position, as well as just getting them the best rate with the best product and the best bank as well.
Fantastic. And I guess it's probably fair to assume, like, you know, I deal with on a daily basis in terms of the property purchasing side, where everybody thinks there's a one size that fits all, but which there absolutely isn't. Is that fair to assume in the brokering space as well, just going off what you talked about there?
Yeah, massively. So if everybody has completely different financial positions, and then your financial position might determine not only the strategy that we use, but what type of finance we secure for you, which banks you're going to go with as well, whether you're a really straightforward, like you said, 2 payslip customer, where all of the banks are happy to deal with you. Maybe you're a more complex self-employed customer where some banks will assist you and some banks won't. And we've got to be really across all of those differences and nuances in all the different banks' policies to work out how we can actually get the right finance solution in place for what you're looking to achieve as part of that wider strategy. So it's definitely not one size fits all in terms of the actual customer's finance application. Definitely not one size fits all in terms of their long-term strategy and planning and what they're actually trying to achieve and how we help to get them there.
It's super complex, and I guess we've seen that firsthand in terms of how deep you go with clients. I guess when it gets to the next part of the strategy, obviously borrowing capacity is a really big element. Could you maybe just give us a bit of a talk through in terms of firstly what borrowing capacity is and what are maybe some levers that can impact it in the good or the bad, and what clients can, I guess, do to improve that?
Yeah, definitely. So borrowing capacity, it's a tricky topic because we don't want to go into a meeting with a customer and say, this is your maximum borrowing capacity. Okay, because what they're actually comfortable in terms of their monthly cash flows and their ongoing repayments and their commitments versus what the bank says you can borrow on paper could be two completely different things. Okay, so what the bank will actually look at to work out borrowing capacity, it really boils down to a multiple of your household income versus the total amount that you want to borrow against the loan, and then also factoring in any other financial commitments you have. So your normal household living expenses, depending on your actual spending patterns and how many people are living at home and how many kids you have, any other debts you have, which could be car loans, personal loans, credit cards, afterpay, anything along those lines all gets factored in. If you wanted to look at it in a bit of a sweeping statement, which I probably wouldn't recommend, at the moment, with interest rates being higher than they were historically for the last, say, 10 years, borrowing capacity for everybody's down about 30 or 40% compared to what it was, say, during COVID when rates hit all-time lows. So back then, you could borrow something like 7 times a multiple of your before-tax income, whereas now it's reduced down to about a multiple of, say, 5 times your before-tax income. But it's going to be different for everybody depending on all of those other commitments that you have in place. That is completely different for an owner-occupied property compared to an investment property as well. So if you're looking at an owner-occupied property, a lot of people don't realize that you can actually borrow less for an owner-occupied property compared to what you can borrow for an investment property. When the bank's assessing an investment property, they're not only looking at the debt, but they're also looking at the tax deductibility of that loan. They're looking at the rental income that's going to be coming in against that property as well. And when those two things are factored in, usually it means you can actually borrow more for an investment property compared to what you can borrow for your owner-occupied property. And when we sit down and go through the cash flows with our clients as well, the cash flows on an investment property typically are significantly less than the cash flows and the amount you have to pay to actually run your own property as well, which a lot of people don't realize. So yeah, it is really important though to take time to understand from the customer's point of view, what are their spending habits, what are they actually comfortable with on a monthly and yearly basis with their borrowing capacity versus what does the bank say that you can actually borrow as a maximum on paper.
Yeah. And is borrowing capacity equal across the board? Am I going to be able to go to bank A, bank B, bank C and get the same borrowing capacity, or is there discrepancies between each one?
There's different nuances in the bank's policy. So depending on your personal circumstance and whether you're an employee or whether you're self-employed, if you're a self-employed individual, do you pay yourself a salary? Is there net profit in the business? Are there business debts and add backs that we need to consider? So there's some slight differences in the policies between the major banks, but most of them will give you a fairly similar outcome in terms of borrowing capacity, because they're all governed by the same governing bodies and the same regulation. So that the government sits on top of the banks or sits on top of the regulators and says these are all the checks and balances that we've got to have in place to make sure people are not borrowing too much and overextending themselves. Because if they did, that's got a wider knock-on effect to the economy at large. So the regulators sit on top of the banks, and whilst they'll all have slightly different policies, and some might favour our self-employed customers more than other banks will, generally you're going to get a fairly similar outcome. We know which banks are good for which scenarios. You do then have also what's known as second and third tier institutions. So these are smaller companies outside of the major banks. But we know who all the big banks are. The smaller companies, they're people like your Liberty Finance, Pepper Money, Brighton, Latrobe, to name a few. There's a few more out there. So these are smaller institutions who will actually be able to lend you more than what the big banks will offer you. It's what was sometimes referred to as the subprime mortgage market. So these smaller banks, they're still allowed to operate completely legally, but they don't have as stringent rules around borrowing capacity, which means you can borrow more money with them. Okay, but they are slightly more expensive to deal with in terms of fees, in terms of interest rates. But we might have investor clients who they've already got their maximum borrowing capacity with the major banks, and they're really comfortable with their own cash flows. They've got sufficient surplus income that they still want to invest, but they find that the major banks are closed and they can't do any more borrowing with major banks. So we can then look at, well, can we increase your borrowing capacity with a second tier or a third tier lender, who will give you more borrowing capacity. It's going to be a little bit more expensive, but if you're really comfortable with your cash flows, and if this actually ties in well with your investment plan, here's another avenue that we can actually go down to help you on that investment journey.
Okay. And on that, what is it that allows them to I guess, give you more borrowing capacity? Is it they have different add backs? Are they assessing you at different interest rate buffers? Like, what is the determining factor there?
The big one's the interest rate buffers. So just to explain that for everybody. So even though mortgage rates today, if we said for sake of using a round number, you might get, say, a 6% rate on a principal and interest investment loan. Okay. We have to stress test that in our calculator at an extra 3% over and above the actual interest rate. So when I'm chatting to my customer and I'm working out their borrowing capacity, and instead of working out what they can afford based on a 6% mortgage, I've got to work it out based on what they can afford on a 9% mortgage. So there's a huge difference between what your actual monthly repayments are and what we have to put in the bank's calculator. And that's a line of defense that the regulators have told the banks they have to have in place, so that if we take out a mortgage today, but interest rates go up by another 3%, we're not going to be defaulting on our loans and we can still afford to pay our mortgage. So if we've got to add on 3% with the major banks, some of these second and third tier institutions will have slightly different rules where they maybe only make us add on an extra 2% as a rate. Some of them make us add on an extra 1%. Some of them will make us take the actual repayment plus 25% buffer on top of that. So there's a few different rules here with these second tier lenders as to what they do and don't consider. Then you've even got beyond that. If you perhaps you're self-employed and you don't have the ability to provide tax returns and financial statements, if you've got a relatively new business or for whatever reason, that some of these second-tier institutions will just do what they call a low-doc loan, which used to be quite common, but there's less of them around now, where you just get a letter from your accountant to say this is what the income is going to be for the year, and then the bank will approve the loan based on that. So again, as we go from major banks to second, third-tier institutions, you find that borrowing capacity increases, but also the costs involved as well, and it gets more expensive. And then there's also a whole other layer, which is actually private financing, completely separate from the banks, where generally it's really short-term finance, where you might be perhaps a property developer, you're building a block of 4 townhouses, you only need the funding for say 2 years to complete the construction, and then you're going to sell the properties and repay the loan. So that's a whole different sort of area of finance, which is not very common, but it still exists, which is completely private. You're not getting your money from the bank. There's very, very little in terms of the document you need to provide to prove your income, but also very, very expensive, and it's only short-term funding as well. So there's a whole range of options out there depending on what you're looking to do.
Okay, awesome. And I guess when it comes to borrowing capacity, maybe what are your 3 big things that are bringing people's borrowing capacity down, or they can do to improve their borrowing capacity?
Yeah, there's a few levers that you can pull to improve on your borrowing capacity. One of the big ones is your household living expenses. So if every bank has what's called HEM, which is the household expenditure, which is a benchmark of living expenses. If I've got 2 adults and 2 kids at home, this is my income, whichever bracket you fall into, there's a bare minimum of living expenses that the bank has to use as part of your loan application. Now, you might be quite a big spender and you spend quite a bit more than that. If you're thinking we're probably going to be talking to banks and applying for loans, we might want to be cutting back on our discretionary items, big purchases, holidays, eating out, all of the sort of extra things that we spend money on. But if you know the bank's going to be actually reviewing your living expenses, looking at bank statements and credit card statements, cutting back on these things, so you get your living expenses to a sort of more reasonable level that you think is going to be sustainable long term, is one of the first things you can do. Really, the only 2 things are reduce expenses or increase income. Okay, so if you can't increase your income and ask your boss for a pay rise, you've really got to reduce expenses. So you can reduce your living expenses by cutting back on all your spending. Your other expenses might be, you might have car loans, personal loans, credit cards. Credit cards, a lot of people don't know, even if you don't spend any money on the credit card and it's got a $0 balance, if the limit on that card is $20,000, for example, the bank puts the full $20,000 in as a debt, because you could go out and max that card out tomorrow. So if you need to cut back on those credit card limits, take that 20,000 card and drop it down to 5,000. That's going to have a positive impact on your borrowing capacity. The other ones like car loans and personal loans and HEX debts as well. If you've got the cash available to actually pay off those loans and get rid of them, that can improve your borrowing capacity. But I would advise people don't rush out and do that independently. Talk to us first of all and let us work out what's your borrowing capacity now while you've still got the HEX debt and the car loan, versus do we actually want to pay that debt off and give up some of our available cash for the deposit to increase our borrowing capacity? We can work that out and let you know which way that lands and what the best option is. Or do we actually just take some of the equity we've got in our house and use that to pay off our car loans and our HEX debt? Because that gives us better borrowing capacity now, but we've got to be really cognizant of the fact that we're taking a 5 or 6 year car loan and we're adding it into a 30-year mortgage. So potentially that's going to be more expensive for us in the long term. So there's a few levers you can pull to try and improve on that borrowing capacity, but there are a few other things to consider there too.
Hey, fantastic. There's obviously a lot to unpack there for people taking away going through the module today. I guess the next thing we want to cover off is loan to value ratios. There's obviously big discrepancies, different products fit in at certain loan to value ratios. Would you maybe just give a bit of an insight around what's the benefits, which one do investors tend to go to, and when you're working through with clients? Yeah,
of course. So loan to value ratio, broken down really simply, how much you're borrowing as a percentage of the property value, or there could be multiple loans and multiple properties involved, but it's the amount of the debt as a percentage of the property. So the banks will do what we call pricing for risk most of the time. So the more risky your loan application is in the eyes of the bank, the higher the rates they're going to charge you and potentially charge your lender's mortgage insurance as well. Okay, so having a 20% deposit was traditionally the sort of sweet spot in terms of financing, where the bank will say, look, that's a relatively low risk transaction to us, because if anything goes wrong, you lose your job, for example, the bank has to sell that property or you have to sell that property to pay back the bank. There's a 20% buffer or margin for error there, because you had a 20% deposit and you only borrowed 80% of the property value. relatively low risk. We're not going to charge you any lender's mortgage insurance, and we're going to give you a discounted rate. We can go actually further on that now. If you now have, say, 70% loan to value, so you've got 30% either deposit or equity build up in your property, you get a cheaper rate. If we get you down to 60% loan to value, you get a cheaper rate still. So really, in an ideal world, we'd all have as much equity as possible, because the loan application becomes easier, the banks are easier to deal with, they're going to give you a better discount, and you're going to avoid lender's mortgage insurance. Okay, so if you're in that position, you're very fortunate. For a lot of investors, they're not in that position because they might be starting out their journey. So they're saying, well, how do I actually get into the market and buy a property now? What are the costs involved going to be if I have, say, a 5% deposit or a 10% deposit? So getting up to that 95% loan to value ratio with just a 5% deposit, that's pretty much the limit, the cutoff point for most banks, where they will allow you to finance the property, but they've got to have that 5% equity there as their sort of buffer in case something goes wrong and they need to get their money back. If you get into that realm, anything above 80%, you will be paying lender's mortgage insurance, which is an insurance policy that the bank charges the customer, and it protects the bank in the event that they can't get their money back. Doesn't benefit you in any way, but you've got to pay for it, unfortunately. So if we go just above 80% to say 85, or if we've got to go 85 to 90 or 90 to 95, each of those brackets, the interest rate on the loan will become more expensive, and then the amount of lender's mortgage insurance that the bank charges you becomes more expensive. So then we've got to consider, well, is it worthwhile sitting on the sidelines and continuing to save up my deposit so I've got more cash available so that the loan is more cost effective, versus the opportunity cost of, if I keep waiting, am I going to keep seeing property prices increasing? And am I better off to get into the market now, take a little bit of a hit on a slightly higher interest rate and a slightly higher lender's mortgage insurance to be able to buy that property now and get into the market and watch it grow over time? Or do I want to be sitting on the sideline waiting? So that's always the trade-off, is that what we call opportunity cost of being able to act now versus waiting. If you've already got equity build up in another property, you can get there much sooner. So if you've got a pretty common situation, you might have your own home, which maybe you did save up the full 20% deposit to get into the market. It's been 3 or 4 years since you bought the property. Prices have gone up. You've also paid off a bit of loan. So now, rather than having that 20% equity, you might be sitting at a 60 or a 70% loan to value, and you've got more equity in that property. So rather than having to actually come up with the cash to fund a deposit for the next property, you can use the equity that's in your own home to be able to get into the next property without having to come up with any cash. Or depending on your equity position, you might still have to put some cash into the deal depending on how it works out. But generally, the maximum you can get to for investment lending, most banks actually cap off at 90%, including the LMI. We've got a couple of banks who let you go up to 95, and then a couple of the second tier institutions that we mentioned earlier who will also let you go up to 95% across either the value of one property or the combined value across your portfolio.
Yep. You touched on something there in terms of clients getting in early, in terms of weighing up those opportunity costs. Having done this personally, can you go back, maybe you purchase at 89 or 90% on an investment property, and then you've had some equity growth, and can you go back and refinance and you go get those better rates that might be available to somebody at 70 or 80% later on?
Yeah, you can. So if you get to a position where the value of that property is increased, you've got some equity, or you've paid off some of the loan, and we've got some equity, and we're now sitting in that 80% loan to value, you can absolutely refinance to get a lower interest rate, but you can't undo the lender's mortgage insurance charge. Once the LMI gets charged to the loan, it's there and you've got to pay it. There's no way of sort of removing that later. But you can absolutely go from, we're on a more expensive rate because we had a really high loan to value ratio, to we've now got enough equity to change. We can even, if we've got to use, say, a second tier institution, one of the smaller banks with a higher rate, just to get you into the market. If your circumstances change in future, that's another thing we can do, where we can take you away from this second tier bank over here, which served its purpose and it got us into the market, and we now want to go back to a major bank and get that interest rate down and make that loan a bit more affordable for you.
Awesome. Fantastic. And I guess the next one, you already touched on a little bit there, in terms of lender's mortgage insurance. You maybe just go a little bit deeper in terms of what lender's mortgage insurance really is, but also, what are the pros and cons of taking it on? And, if it's a cost that we have to pay up front, do we absorb it in some way? Do you want to just go a bit deeper there?
Yeah, absolutely. So don't look at lender's mortgage insurance as necessarily a bad thing, because it can actually benefit you. So as I mentioned, it's an insurance policy that covers the bank. So if you don't have that 20% deposit, the bank, as I said, looks at it as being a more of a risky transaction for them. So they introduced this insurance policy, which if you default on the loan, the bank's got to sell that property to get their money back. If there's any sort of shortfall between what the bank sells the property for and your loan, then the insurance policy can kick in and cover the difference for the bank. So it's really designed to protect the bank's interest, but you as the consumer have to pay for it. So if we could all avoid it in an ideal world and we had enough deposit available not to have to pay lender's mortgage insurance, then we would. The way that it works is the amount gets added onto the loan because you don't have the cash to pay for it, or if you had enough cash to pay for it, you would have had the 20% deposit anyway. So the lender's mortgage insurance charge gets added onto the loan. So you're then also paying interest on top of that as well. So it is actually more expensive in the long run when you think of it that way. But to the sort of other side of that coin is it allows you to get into the market quicker rather than sitting and waiting and saving up for the 20% deposit. So sitting and waiting to save up your 20% deposit, it can be a bit of a trap, because as you're slowly saving up that deposit, if the market's moving, which it has done in recent years, you could be watching that house get more and more expensive over time. So that 20% deposit you need to save is actually also getting bigger and bigger over time as well. So you can get sort of stuck in this trap of just keep trying to save up this deposit and keep trying to save this deposit for the sake of saving what could be a $10,000 or a $12,000 lender's mortgage insurance charge. For the sake of you trying to avoid that and keep saving up, you could watch house prices go up by 50 to 100,000 over that same period of time where you've been trying to save up money just to avoid paying a 10 grand charge up front. Okay, so in that type of market where house prices are going up, to be able to get into the market now and secure the same property for could be $50,000 to $100,000 less than what you might pay for it this time next year if the market's really strong, then paying 10 grand to get into the market now is a no-brainer if that happens. Hindsight's a wonderful thing, so we don't know exactly what's going to happen over that period of time, but it's opportunity cost, and it's something you've got to weigh up the risk of taking the hit and paying it now versus waiting and paying more for that same property.
Yeah. And obviously we're just speaking in general terms here, not being tax advice, but your things like your LMI, the interest you're paying on that is tax deductible to some extent, and also can be offset if you ever sell the property in terms of that's an expense you paid. Is that fair to assume?
Yeah, absolutely. So the actual lender's mortgage insurance charge, that's not something you can just put in your tax return and claim back the next year. But because it gets added onto the loan, the interest that you're paying on that is tax deductible. So any of the borrowing costs, well, I shouldn't say any, because there's some things that aren't tax deductible, but generally speaking, the borrowing costs when you buy your investment property. So if you borrow for the lender's mortgage insurance, if you borrow the stamp duty, if you borrow your solicitor's fees, the interest on all of those parts of the loan is tax deductible. Then when you go to sell the property and you have what's known as a capital gains tax event, all of those costs are factored into the capital gains tax calculation. So if you had to pay lender's mortgage insurance, your stamp duty, those costs will actually be factored into the calculation, which means that although it costs you more now, you'll be paying slightly less capital gains tax in future once they factor that into the overall profit that you've got to pay on the sale of that asset.
Yep. Fantastic. And I guess the next thing we want to kind of cover off now, it's a bit of a complex one, is structuring loans. There's obviously multitudes of ways that you can structure a loan. Would you mind maybe just giving a bit of a brief rundown in terms of what they may be and also what are the pros and cons and what may or may not suit?
Yeah, absolutely. So structuring probably covers quite a few different topics. So we've got to consider when you're setting up this, the structure covers, is it going to be a principal and interest or interest only loan? So I'm actually paying down the debt. Is it actually an owner-occupied debt, or is it a tax-deductible investment debt? Whose name do we put on the loan? Is it going to be in the name of jointly with both spouses, so that we can use both incomes for the approval? And then whose name do we put on the title for the property for tax purposes? Is it going to be in the name of one or the other, or is it going to be 99% in one? Is it 50-50? There's a whole range of things we can go through in terms of structure. The first one, I guess, to consider that I mentioned there is whether we go, well, first of all, is it owner-occupied or is it an investment? Okay, so to cover off on that pretty briefly, the house that you're living in is going to be owner-occupied. A house that you're actually renting out and you're deriving an income from is going to be an investment. So we've got to work out, first of all, what are we doing? Are we buying a property that you want to move into, or are we buying an investment property? And for the vast majority of our customers, it's going to be an investment property. But there could be situations where we actually look at, well, we're buying a property which we think we're going to rent out for the next year, but then we might move into that at some point in the future as well. Or are we actually going to be upgrading and buying a new property, and we're going to be using our existing property as an investment property? And how does that work? Is that the right structure for you to hold on to that owner-occupied property as an investment? Or do we actually want to be selling that property and using the proceeds so that we can then have a bigger deposit to put down against the owner-occupied property? So there's a lot of different things to consider with structure, and the loan-to-value ratio falls into that as well, and also the tax deductibility of the loan. So just going back to if you're buying multiple assets, for example, and we are going through the strategy of, well, we're going to be buying, we've got our owner-occupied house and we're going to be buying the next property as an investment. So how do we want to structure that? Well, we want to structure that, first of all, in the most tax-efficient way possible. So when we say tax efficient, we want to have as much debt on that investment property as possible and as little debt on our owner-occupied house. The owner-occupied house is not tax deductible. You can't claim the interest on that when you do your tax return at the end of the year. The interest on your investment property is tax deductible, so you claim back the interest cost on your personal tax return. So we want to get into a position where we actually keep all of our cash against our owner-occupied house. We're not taking cash out and putting down a deposit on our investment property. So we try and structure it so that we can borrow 100% plus costs on the investment and not actually use any of the cash out of our owner-occupied property. That's probably one of the most important things to consider of structure is how are we financing the purchase? Are we using equity to fund it and allowing us to borrow 100% plus cost, or are we going to put down a cash deposit? And that falls into the whether or not it's going to be tax deductible. Adding to that, then structuring it as to how are we actually going to get to a position where we're clearing our non-deductible home loan debt first. So the structure there, you would consider, do we go a principal and interest paid out against our house? So we're actually paying down the debt on the house that we live in. And then what do we do with the investment property? Do we keep the investment property on an interest-only basis? So you're actually maintaining that debt and you're not paying it down, because we know we can claim a tax deduction on this. So if we keep the investment property on interest only, it means that all of our additional cash flow, rather than making principal paydowns on the investment property, we redirect that cash flow to our owner-occupied house, and we can actually pay off our house faster and have more deductions to claim against the investment property because we went principal and interest on this side and interest only on this side. Those are some considerations for structure. Then in terms of the actual ownership and whose name's on the loan. So we generally want to be able to claim those tax deductions and structured in such a way that whoever, if there's husband and wife or spouse involved, whatever it might be, we want the tax deductions to be in the name of the higher rate taxpayer. So to get the tax deductions in the name of the higher rate taxpayer, you want to have the title of the property in that person's name, not the loan in that person's name. So a lot of people don't realize this. You could have both people named on the mortgage. They're both named on the loan because we want to use both of their incomes to actually get the loan approved through the bank, because two incomes is going to improve on our borrowing capacity. But we want to be able to claim as much of the deduction as possible against one person's income because they're in a significantly higher tax bracket. So the name on the loan does not dictate who's actually claiming those deductions. It's the name on the title of the property. So rather than doing just a normal 50-50 split between two partners, we want to look at, well, do we actually do it 100% in one partner's name and not have the other partner named on the title at all? Or do we want to set it up? We still want both people to technically have ownership in that property. So we can do 99% of the title in one person's name and then a 1% split in the other person's name. That's a pretty common structure that we use. Relating to the tax deductions on it. The other structures you can look at as well is, well, do we actually want to look at, rather than putting in our individual names, do we want the property to be owned in a trust rather than being in individual names? So I guess that's a whole new topic. Some of the pros and cons of doing it in a trust, it depends on your circumstances. The first one that you can't do when you have the loan in a trust is you can't claim those tax deductions that I mentioned, which is what's called negative gearing. So to be able to claim those tax deductions against your personal income, if you are a normal PAYG employee, you really need to have the loan in your personal name to claim the tax deductions. Because if it's in the trust and that trust makes a loss at the end of the year, you can't then take that loss from the trust and transfer that over to your personal tax return. If you're a self-employed individual, you could technically take the profit that you make in your company and then redirect that to the trust to offset that loss, so you're actually claiming a deduction against that.
Yeah, and Fada, we'll get into cross-collateralisation in a bit more detail here, but what you're kind of saying there is, and correct me if I'm wrong, so if I'm buying a property, maybe cross-collateralised, or I've gone in 105% purchase costs on that property, I put no loan down, so I bought my $500,000 property, and it's essentially a $525,000 loan instead of going maybe 80% loan. I'm essentially getting an extra 25% of my maybe 6% interest rate of tax deductible debt, which, you know, could be $6,000, $7,000, $8,000 per year over a 30-year loan. Is that kind of what you're saying there? Which you're going to be able to tax deduct that, versus in another setup you might be able to deduct none of that. Is that sound about right?
Yeah, absolutely. So if you, to be able to deduct, if you've cross-collateralized and you've used borrowed 100% plus costs, it means that all of your borrowing costs are going to be tax deductible. The interest on all of those borrowing costs is going to be tax deductible. And it means that you can leave all of your cash sitting against your own personal mortgage. Okay, it means that it's going to be more expensive to run that investment property on a monthly and a yearly basis, because we've purposely borrowed more and we're purposely paying more interest against that, because we're now paying less interest against our owner-occupied house. So for some of our clients will not want to do things that way, and they'll specifically say, I do not want to use my house as any part of this transaction. I'm happy to take a 10 or 20% deposit out of my personal offset account against my mortgage, and I'm going to go and use that to finance the investment property, and that's the way they want to do it, and that's absolutely fine, and we're happy to do things that way if that's the customer's preference. But what that means in a practical sense is that 20% deposit that you just took out of your offset account over here, that could be an extra $150,000 worth of interest that you're paying on your personal mortgage. So you're now paying more interest against your own house, and you're paying less interest against the investment property, which means you've got less deductions to claim. So it's considering, am I happy with using the equity in this property to finance the next one because it's the most tax efficient way of doing things, or do I want to be able to put down a cash deposit against it?
Yep. And I guess going back to the trust side of things, it seems like it's got a fair few limitations. But maybe, is there a type of person or persons that it may be more suited towards?
Yeah, there's benefits for trusts. So the first one is actually asset protection from a legal point of view. So there's certain professions out there who are at high risk of being sued, which could be doctors and dentists. They could be sued for medical malpractice. So a lot of the time they're really conscious of that, and they want to make sure that in the unlikely event that was to happen, their assets are protected. So rather than having properties in their personal name, where if they get into that scenario, those assets are owned by them personally, they'll actually put those properties into a trust so that they're protected, and they technically don't own that asset. It's owned by the trust. That's one of the first ones that we see. From an investment point of view, one of the ones that we see, which is a pretty specific strategy, is if you are buying properties in a trust, there's the potential to actually be able to increase your borrowing capacity by using the trust. It's fairly specific to a couple of banks who will allow you to do that, but it's a situation where if you own this property in a trust and then you want to go and buy the next investment property, the majority of banks out there will say, well, let's look at your overall borrowing capacity and what's in your personal name, what are the debts that you've got in this trust, and we're going to build all this into our calculation when we go to buy the next property. There's a couple of banks out there that will allow you to, if you have a property in a trust, it doesn't need to be included as part of your overall borrowing capacity for the next purchase if that trust is actually profitable, and your accountant's happy to sign off that trust is profitable. So if we get to that situation where we've got an investment property in a trust, it's positively geared and it's cash flow positive, we can then go and buy the next property in the trust. If that's also positively geared and it's cash flow positive, we can then go and buy the next property in the trust. And they don't actually have a direct impact on your overall borrowing capacity if we can get the verification that they're positively geared, and we use a bank who, as part of their policy, they're actually happy to accept that as well.
And, having a bit of experience with this, it sounds all well and good to people listening, but maybe like, oh, unlimited borrowing capacity sounds great. It's a really specific type of property that's actually going to make that happen, right? You're going to need property that's running with a really good yield, potentially a lower LVR. It's not going to really work for you on a higher LVR in most instances. It's only going to really work in certain circumstances.
It's harder to achieve today compared to what it would have been 2 years ago. Okay, because interest rates now are, say, 6%, getting up to, say, 6.5% for an interest-only investment property, rather than a couple of years ago where you could have got a 2.5% to a 3% rate. So if your property had a 3% interest rate and you were getting a 4% rental yield, that property is going to be, after all your other running costs, it's probably going to be neutrally geared, maybe slightly positively geared. Okay, so that was a lot easier when rates were low. Now, if we fast forward 2 years, rates are up at, say, 6 to 6.5%. Rental yields have also increased, but the rental yield might now be 5.5%. So immediately, depending on how much you borrow, if you're borrowing 100% of that property value, if the rent's 5.5%, but the mortgage is 6.5%, you're immediately negatively geared. Okay, so you're not in a situation where you can say, well, this property is positively geared, so I'm not going to include this in our calculations. If you have a sizable deposit to put down and you're, rather than borrowing 100%, you might be coming in and borrowing 60 or 70%. If you're in a position where you've got the cash available, or you pull the cash out of another asset and use that to finance the property in the trust, you can make it work, but it's more difficult now compared to what it was when rates were a lot lower.
Yeah.
And then, the other consideration is, just because the bank says you can do it, can you actually afford it as well? Okay, so then you've got to work out, well, if I've got my properties and yes, it's positively geared within the trust, but then I go and buy 3 or 4 and I want a really aggressive investment strategy because that's my risk profile and that's what I want to do. But then if we get to the situation where now rates have gone up, now all of a sudden your interest-only mortgage is actually converting to principal and interest, so your repayments are going to be a lot higher as well. Multiply that by 3 or 4 properties, and if you haven't done your sums initially, you've got the potential to get yourself in a bit of financial strife. So just being really across your cash flows, and if you want to go use one of those strategies, making sure you've absolutely all over your cash flows and you understand where you are now and where you would be in future in case that happened.
It's fair to say that's, it's not really for a novice investor going down that path. You need to really know and understand property and your finance side of things as well. But what I kind of want to touch on now is more so the cross-collateralisation side of things. I know we've touched on it a little bit, but you maybe just want to go a little bit deeper on that. What is the big tax benefits as well that happens on that?
Yep. So cross-collateralisation is taking the equity and it is taking cross-securing is easier to say. So using the equity in this property to finance the next property. So the way the bank looks at that is when they're assessing the security for that loan application, they actually combine the value of the 2 properties. So I like to use round numbers. Let's say you've got your owner-occupied house, which is worth $1 million, and then you're buying an investment property for $500. So we've got $1.5 million of assets to use as security. Okay, and if you're trying to get in with say an 80% lens, you're avoiding lender's mortgage insurance, then the bank's calculating that 80% against the $1.5 million of assets, which means, if my mental arithmetic's right, that means that you can borrow a limit against those properties of up to 1.2 million. So you've got 300,000 as the 20%. So that 1.2 million, both loans for your existing property and for the investment property you're purchasing have to be under that limit. And the bank basically, they're still separate loans. So you've still got an owner-occupied loan and an investment loan. But for the purposes of calculating that overall equity position, the limit of those both loans is combined and taken into consideration. So in that case, if you've got your $1 million house, but you've paid it down, you only owe 500,000, and then you want to go and borrow, buy a property for 500,000. You want to include your stamp duty, you want to include your buyer's advocate's fee, your solicitor's fee. You might end up buying for 500 and borrowing 540, or an extra 10,000 on top of that if you want to renovate. You can borrow the full amount without putting any cash in, because we've got lots of equity from your owner-occupied property. And when we combine the existing and the new loan, it fits under that overall combined limit against the two properties. So the downside to doing that is when you go to sell one of the properties, the bank, the two of them are to some extent combined. So the bank has to make sure when you sell this property over here or this property here, the remaining debt against the other property is within the limit that they're comfortable with. So if you've got an investment property where you've borrowed 105% and then you go and sell your owner-occupied house, the bank isn't going to leave an investment property sitting at 105% because that's way above what they're comfortable with. They're going to want you to take some of the proceeds from the sale of this property and pay the new one down to 80% ideally, or if it's above 80%, you're paying lender's mortgage insurance. It's not a huge risk, and I've never really seen it go bad or go wrong unless it's a situation where the value of the property's come down. Because generally, if we're buying the right asset in the right market and the value of that property has gone up, even when you go to sell and the bank says, look, you need to pay down the loan, you can actually say to them, well, I'm going to go and get a new valuation done. And if that 500,000 property is now worth 700,000 or 800,000, I can actually just leave the loan sitting at 550 without having to take the proceeds from this sale to pay down this property as well.
Which in most cases, if you're buying the right asset, you're not buying something off the plan, an apartment, you're not really going to see that aggressive drop in value.
Yeah, you shouldn't, unless, if we look historically at the last, over the last 12 months, there'll be people who bought the wrong properties. And then they bought at the peak of the market in the wrong market, and some of those might have come back 10% over the last year because rates went up. But if you bought the right property in the right market, you'll be fairly well protected from that. So you'd have to be a pretty bad example for that to go wrong. There is another way of doing it, where you can achieve pretty much the same outcome without cross-securing. It just looks a little bit more messy from a paperwork point of view. So rather than saying, I'm going to take my owner-occupied house and I'm just going to use the equity to finance the next without 105% on that one, what we do is, if you say, like, I really don't want to cross-secure, I just don't like the idea of doing that, I don't want the sale of this property to affect the sale of this property, absolutely fine. All it's going to look is a little bit more messy when you look at your online banking, because you're going to end up with 3 loans. So you've got your home loan, and then you do an equity release just specifically against this property to cover your 20% deposit plus costs. So you're still borrowing the same amount. And then when we do the investment purchase, it's a separate 80% loan to avoid the LMI. So you're still borrowing the exact same amounts across both properties. From a tax point of view, you're getting the exact same deductions. You're just not linking them up. You're doing a separate loan to cover your deposit and costs, and then a separate loan at 80%. You still have a portion of the investment property secured against your house, but it's only the 20% plus costs, and then the separate loan for the secured against the investment property.
Yep. Awesome. And I guess the next one we want to cover off is guarantors. Can you maybe give us a bit of insight when you would use it, when you need to use it, pros and cons?
Yeah, there's a couple of different categories of guarantors. So there is, well, first of all, if you're buying a property that's not in your personal name, so if you're putting it into any other sort of structure, whether that's a family discretionary trust or a unit trust or even super fund lending, you're generally expected to sign a guarantee against that property. And what that guarantee says, without getting into the sort of legal aspects of it, is in the event that the trust isn't able to pay off the loan, it falls on you personally as the guarantor to cover it. So it's your responsibility. So that's a guarantee that you have to sign out of necessity if you want to use another structure. There is the most common type of guarantee is a guarantee to cover the deposit on the property. So that might be if you don't have enough cash to actually buy the property and get into the market, if you don't have enough deposit, but you've got parents who have got equity in their house and they're happy for their house to be used to help finance your purchase. So the way that works is if we use the parents as an example, they don't actually pull any cash out of that property and hand it to you. They just say to the bank, we will use whatever you're buying your investment property for, but whether it's 500,000, 600,000, whatever it might be, 20% of that amount is secured against the parents' house, and they provide a guarantee just over that 20%. You can do that if there's no mortgage on their house. You can do it if there's an existing mortgage, and then the new bank just puts a second mortgage on to cover that 20%, as long as they've got enough equity there to do it. So that used to be known as a family pledge or a deposit guarantee. That can be a pretty handy way for you to get into the market quicker if you've got the income, you want to be able to invest, you've got the risk appetite to do it, but you just haven't had a chance to save up the deposit funds. Maybe you've been studying and now you're in a high-paying job, and all of a sudden you've got the income but not the cash. You can get the parents to help out with it. The other type of guarantee, which is less common these days and you don't really see, is what's called a servicing guarantee, which is when you actually do have enough deposit and cash to buy the property, but you don't necessarily have enough income. So that's when somebody else might come in and say, well, I'll provide a servicing guarantee, which is to say that you're going to assess their income as well to assist you in your ability to repay the loan. It's less common these days. Banks don't really like doing it because they want the individual borrower to have the ability to pay that loan without having to rely on a third party. But it is something that we can still access out in the market if you have to.
Yeah. Awesome. And I guess the common question I get asked daily, principal and interest versus interest only. Like your thoughts in terms of which one a client may or may not go, and the benefits or negatives of going a certain way. Yeah.
So you want to be paying off your debts. So you want that debt to be gone as quickly as possible. That's the sort of long-term investment goal is to increase your net worth, increase your assets, and decrease your debts. But we've got to be more strategic than that. We don't want to just have everything on a principal and interest pay down, depending on your circumstances. So generally, your owner-occupied house is going to be on principal and interest pay down. We want to get rid of that debt. It is, even though you get a slightly cheaper rate on your house, it's the most expensive debt you have because it's not tax deductible. So we want to get rid of that debt as fast as we can. So we'll generally do a principal and interest on your own house. There's some sort of rare circumstances where you might do interest only on the house that you're living in if you know that that's going to become an investment property in a couple of years. Or if you think, look, we're only going to be here for a while and we're actually going to sell it and we want to use our cash flow to save up a deposit for something else. There's some sort of rare examples of doing your own house on interest only. The banks really don't like doing it. They've got a bit of a directive that they want everybody's owner-occupied residence to be on principal and interest paydowns, but it can be done. Generally for your investment properties, whether you go principal and interest so you're reducing the debt, or whether you go interest only so you're just maintaining that debt, it really boils down to, well, do I have a mortgage on my own house or not? That's generally what we discuss with our customers, because if we've still got a mortgage on our house, well, we want to pay that off first. So we don't want to be having to make big principal payments to our investment property or our multiple properties while we're still paying off our house. So go interest only on the investments, maintain the debt on those, and make extra repayments to your house so you're clearing that debt faster, reducing the non-deductible debt, maintaining the tax deductible debt. The other consideration then is cash flow as well. So you could have little to no mortgage on your house and you're really comfortable with that and you don't mind. And now we're just looking specifically at the investment portfolio. And what do we do with the loans that we've got here? Do we have them all on principal and interest so we're paying it down? Do we have some of them principal and interest, some of them interest only? Do we have the whole lot on interest only? So it's going to depend on your cash flows and what you want to achieve. If your goal is purely, I'm happy with the investments that I've got and I just want to pay off the portfolio, I've got lots of cash flow, I'm a high earner, I'm happy to do that, we can have all of the investments on principal and interest pay down so you're reducing the debt. You could be in a position where, like, I want to clear the debt, but I'm not comfortable going principal and interest on everything because it's too much for me on a monthly basis and I'm not comfortable with those cash flows. Well, we can do one or two properties, principal and interest, the rest on interest only. And then if you are actually don't want to clear the debt on those properties, that could be because you're trying to save up some additional funds to use on the deposit for the next place. It could be that you are maybe a more aggressive investor with a bigger risk appetite and you want to have all of your investment properties on interest only because you put all your cash into the stock market on the side as well and you don't want to be directing more cash to your investment properties. Then we can keep those on interest only. So it's all about the customers. Well, first of all, their overall position with their owner-occupied debt and their investments. And then in terms of their cash flow, how do they want to structure things? Is there a specific reason why we should do it one way or another? And then I guess their risk appetite as well.
Yeah. Awesome. And I guess another common one, I'm sure you get this all the time as well, is pre-approvals. So do we need a pre-approval in place? What's the benefit of putting it in place? Do you mind just giving us a bit of a rundown on that one?
yes is the short answer. If everybody should get a pre-approval. It makes life a lot easier for you in the long run, and you can avoid some big mistakes. So the pre-approval, there's two types of pre-approvals out there. So you've got to be cautious with this. There's the online auto-generated, I put my basic details in and it spits out a pre-approval. Okay, it's a complete waste of time. It's not worth it. The bank hasn't looked at it. Every bank in Australia, as far as I know, even the ones that claim to be digital, they still have an actual physical person who approves your mortgage, and it won't get signed off without it. So if you're going online and getting a pre-approval and it's not being looked at by somebody, it's a complete waste of time, because there's going to be a real person that comes in and eyeballs your pay slips and bank statements and credit cards and tax returns at the end of the day. So we've got to go down the path of what we call a fully assessed pre-approval. So we've got certainty. So the whole point of doing it is we want to have absolute certainty as to the amount you want to borrow, and make sure the bank's looked at it and they've signed off on it and they're happy with it. We want to get the pre-approval done so that we're doing all of the legwork up front. So it might be a little bit more painful up front in terms of providing payslips and bank statements, and then the bank comes back and asks questions about your spending or your employment or whatever it might be, and we've got to dig out 2 years worth of bonus payslips from the previous year to get the bank to sign off on it all. Might be a little bit more painful up front, but we want to get to a position where the approval is approved subject to just getting the contract of sale and the valuation for the property. So everything else has been taken care of, and then we just focus on finding the right property. Or you just focus on finding the right property. So that'll save you a lot of headaches in the long run. It'll also give you better bargaining and better negotiation power if you're talking to a real estate agent, or if your buyer's agent's talking to a real estate agent, and you can say, we're already pre-approved, it's already taken care of. We can either completely remove the finance clause from the contract, or we can go completely unconditional, which is much more attractive to the sellers compared to somebody who wants a 14 or 21 days finance clause and they're just left twiddling their thumbs, not knowing what's happening. So we can go completely unconditional from day one, make your offer much more attractive, because we've already sent everything to the bank and we've got finance pre-approved. Or we can say, we'll waive the finance clause, but we just want it subject to standard building a pest and valuation clause. It just made the offer as attractive as possible, which if you've got the pre-approval, it puts you in a much better position to do so.
Awesome. So next one, Lewis, I guess probably want to just pick your brain and I guess go through what are the common mistakes most people go through when they're going to get finance.
Yeah, the biggest one I actually think is the one that falls into your area of expertise, which is getting the wrong asset. So when we can see customers who we've spoken to, and then, or it might be the first time that we've dealt with them, and they've dealt with other brokers or buyers advocates before, and they bought the wrong properties, and we do a review and they just haven't performed as they should have. Okay, so in terms of our long-term strategy in trying to assist our clients, the biggest mistake we see is people who get the wrong assets and then they end up having to sell them anyway. From a finance point of view, the biggest mistake is probably setting up the structure incorrectly from the beginning. So the mistake that people can make in terms of doing that is maybe saying to take out, say, a 20% deposit to go and buy an investment property when that cash should have been sitting in the offset account against their owner-occupied house. So they're getting things set up incorrectly from a tax point of view, which is, I mean, it's not the end of the world, but on an ongoing basis, if you add up the amount that you would have been paying an additional interest on your house and the tax deductions that you've missed out on, that can add up to a lot over a long period of time. Other mistakes, potentially locking in rates at the long time could be a big one. So right now, we're at the peak of interest rates, or we think we're at the peak of interest rates. They could go up further. We never know for sure. But if you were to lock you can, the banks, potentially they've set a little bit of a trap. So you could lock yourself in now for a 5-year fixed rate, which actually looks quite attractive as to where it sits in relation to variable rates just now. But if we're at the peak of interest rates and they start to come back down over the next couple of years, you're locked into this really high 5-year fixed rate when everybody else's rates gradually been coming down. So you can potentially lock yourself in at the wrong rate. Not utilizing offset accounts and redraw correctly, which is maybe a sort of a different topic again. When you are paying down your house, if you're putting all of the cash into an offset account, if you want to then use that money to go and buy something else, you can pull it out of the offset account. The loan that you've got on your investment is still tax deductible because you haven't actually touched the loan. You've had separate cash sitting in an offset account. So if you want to offset your house, but then you decide to rent that property out later, you want to maintain all of that debt because it's tax deductible. And in the short term, we use the offset account to reduce the interest. We sometimes get people who will, rather than having an offset account, they'll use what we call a redraw, where they'll take that same loan, but they'll dump extra cash into the loan, and then they'll try and pull that money out back out later and increase the loan and re-gear it to try and claim a tax deduction. That's completely against the ATO rules. So if you do that and you try and redraw against the loan, you can't claim any deductions against the amount that you just pulled back out. You can only claim against what was the balance that you'd paid down to. I mean, that's where your sort of average banker or broker doesn't have a really in-depth knowledge of those tax rules and how we should structure things, which is what we spend a lot of time explaining to our customers. We're doing a bit of financial education around as well. Any other mistakes? That's really, I mean, those are really the main ones, is just making sure you've got things set up correctly from a tax point of view, so that moving forward you can sort of make some smarter financial decisions.
And it might not seem like little mistakes, but they can be costing you thousands and thousands of dollars, which over the life of the loan can add to tens of thousands of dollars. So it's really important you get right at the beginning. Next one I wanted to cover off with you is deductible and non-deductible debt. Do you mind just giving it a little bit of, I guess, from obviously a loan perspective?
Yeah, we talk about this all the time, and we've probably mentioned it a few times already, but just to really clearly explain. So sometimes it's called good debt and bad debt. So non-deductible debt is it's a cost. You've got to pay it. It doesn't benefit you at all. So that's typically debt against your owner-occupied house. It might be your car loan if you've got no business use against your car loan. If you take out personal loans to do renovations or anything, that's all non-deductible debt. It's just a cost. It doesn't benefit you in any way because you used that for a personal purpose. You didn't use that for an investment purpose. So it all boils down to, when I borrowed that money, what did I use that for? And if it's for a personal purpose, it's non-deductible. Tax-deductible debt is money that you've borrowed for an investment purpose. So generally, the vast majority of the time, that's going to be for buying investment properties. So if we borrow money and we use that to purchase an investment property, it's tax-deductible debt, which means that we can claim the interest on that loan against our taxable income when we do our tax return at the end of the year. You can't claim anything for the principal pay down of the loan, because that's just giving money back to the bank that you borrowed. That's not a cost. But the interest that you borrowed on that loan, that is tax deductible. So when you do your accountant does your tax return at the end of the year, you'll have your rent coming in on that property. You'll have all of your expenses that you can deduct, and the interest on that loan is going to be one of those deductions. And that's going to form part of your overall tax position when you're working at your taxable income for the year. Pretty important just now, because the vast majority of investment properties are going to be negatively geared, which means that the running costs on the property are higher than the income that's coming in. So we want to make sure we get our non-deductible and our deductible debt set up in the right way, that we've got as much tax deductible debt and as little non-deductible debt as possible. The other thing to consider, which some people don't realize as well, is people think if I borrow money against my investment property, it's tax deductible. Well, it's not. So if you've got it's not if you use it for the wrong purpose. So if you've got lots of equity in your investment property, and then you go, I feel like getting a new Range Rover, and you pull the equity out and you go and spend 100 grand on a car, people might think, well, I borrowed it on my investment property and, it's with my investment loan, so it's all tax deductible. Well, unless you're actually using the asset that you purchased as an investment, then that's not going to be tax deductible. So if you take money out of an investment property and go and use it for a personal use, then that's not tax deductible, because the rules of the tax office are, it's all about the purpose of what you borrowed that money for.
Yep, no, it makes perfect sense, and we've covered off various parts of it through as well. And I guess the last thing I want to run through with you, Lewis, is I guess, what is the big benefits of, approaching a broker versus, going to a bank?
Okay, I've been in both situations. So I was in the banking sector for a long time, as most brokers probably started off in banking and then transitioned over to brokers. So we've got a really good knowledge of how both industries work. So the banking industry is just constantly changing all the time. So big changes when we had the Banking Royal Commission, big changes when we had a lot of pressure on interest-only investment lending, big changes through COVID when there's obviously huge amounts of uncertainty in the market, big changes happening in the last year with interest rates going up by 4% in the space of a year, which is the fastest increase ever. So when you have these changes, the banks change their risk appetite and they change their internal policies as well. And I can remember working within a bank, and all of a sudden there's a directive that comes down and they say, we've got too much exposure to interest-only lending for property investors. We need to wind back on that, and we need to increase our rates for property investors, and we need to focus more on owner-occupiers. Okay, so for you as a consumer, if you're going direct to that bank, you are just at the mercy of that bank and whatever decisions it is that they happen to have made at that point in time to please their board and to please their shareholders. We've got one of the big banks just now that's basically come out and said we're ending the mortgage wars, so we're not going to offer heavily discounted mortgage rates to our customers because we've got to protect the interests of our shareholders. So the banks are always looking after their shareholders more than their customers, in my opinion. So if you were to walk into that bank directly, you're going to get a terrible rate because they've made that decision as a business to sacrifice their mortgage book growth to protect their balance sheet and protect their profit. So that's a business decision of the bank. If you come to a broker, we're not beholden to any one bank. We're not at the mercy of their particular flavor of the month or whatever they want to do. We're working for you, so we're trying to find you the best deal. So we are going to all of the banks. We've got a really intuitive understanding of which banks are good at this point in time, which ones are actually offering decent discounts, which banks actually have the risk appetite to deal with the type of transaction that we are dealing with, whether that's the really aggressive property investor who's got lots of properties and trusts, whether that's a self-employed individual who's only been running their business for 18 months and they don't have a full 2 years tax returns. So we've got to have that understanding of which bank do we use for that particular transaction and which one's going to best fit the customer. So that's the biggest difference, is having access to multiple institutions, multiple different it's not so much shopping around for rates, but that's obviously important, and we do that. But it's finding out the right bank to get the right financial solution for that customer so that they can continue the strategy and they can invest. If you want to buy an investment property today and you're self-employed, well, we can take you to the bank that looks at that 1 year financials. If you just had a really good year, but previously you had a bad year because of COVID, we know which bank to go to. If you walk into the wrong bank off the street and they say, look, well, we've got to look at 2 years financials. Sorry, can't help you. Come back next year. Well, you've just missed out on your window of opportunity to buy that property because you've gone to the wrong bank who doesn't want to approve the loan based on your most recent year's financials. So we've got a really intuitive understanding of where do we go to for which particular scenario. Then do we even go outside of the banks, and do we use private funders? Is there a situation where we're actually better off to have certain properties at a certain bank and then do the next application at a different bank as well? So there's a lot of different scenarios that are out there. So we've got to have a much higher, much better knowledge of all of the different banks and what they're doing. We actually have to be qualified as well, significantly more than the banks. So there's little to no qualifications to be a mortgage advisor within a bank. The latest rules for mortgage brokers is we've got to be diploma qualified in mortgage broking as a minimum before we can get our accreditations and talk to customers as well. So a lot of people will go from working for a bank, then they move to broking, and their eyes are open to see that there's just so much more involved with the job that we do compared to a bank that's just got one product and one thing that they're pushing.
And probably last question, I really appreciate you going through lots of detail over various topics today, Lewis. Is it fair to assume, that ALIC is a large brokerage and a big loan book, comparing, say, somewhere to like an ALIC versus Joe Smith who's starting out, he may only be working with a couple of lenders where, you've got a larger book. Is that fair to assume?
Yeah, I mean, I don't want to disparage the one man band down the road, but yeah, we've got a level of knowledge and expertise relating to property investment that I would say 99% of the brokers out there don't. So not only have we got this really big book of investor clients who we're just talking to all day, every day about property investing, we've got to really intuitively understand whilst we're not accountants, we've got to understand the tax implications of one structure and one strategy versus another. We're not financial advisors, but we've got to understand customers' long-term strategies and what they're looking to achieve for themselves financially as well. So we go really in-depth in terms of all the structure and the strategy. In terms of the actual funders that we use as well, if you're a smaller one-man band, you're probably not doing a huge amount of loan applications because you're spending a lot of your time doing a lot of admin stuff and a lot of paperwork, and you maybe only have a few customers on the go. And most of those customers probably fit the bill with one of the big four banks or one of the smaller banks. We're talking to a lot of customers and a lot of property investors. So we'll have a lot of applications with the big banks. We do most of our lending there because they've generally got a good risk appetite to deal with investor clients. That they're generally going to give us the best pricing as well. So that's where most of our business goes. But then we've got a lot of customers who don't fit the bill with the big banks. So we're also talking to some of the smaller institutions as well. Some of the second and third tier lenders, we're in regular contact with them. We're using them quite a lot for some of the more out of the box transactions that your other broker probably won't even see one of those in the 10 years of broking. And then we also do, probably another topic, we do a lot of work in the self-managed super fund space as well. So we've got a lot of knowledge and expertise around SMSFs, what you can and can't do, which lenders are good to use as well. So all of our sort of focus is on property investment, and we're living and breathing it all day, every day.
Awesome. Well, I really appreciate your time for today. You've given us a lot of takeaways in terms of building up a strategy in the finance side. And thanks again for your time.
Lovely. Thanks, Julian.